Berkshire Hathaway is a very large and influential company, and it is led by its famous chairman, Warren Buffett. For many decades, his name has been connected to the idea of smart, long-term investing. The company itself is a holding company. This means it owns a diverse collection of other businesses. It also owns significant stakes in publicly traded stocks. Because of its size and its leader, Berkshire Hathaway is watched closely by people all over the world. Many investors look to Buffett's actions and to his annual letters to shareholders for wisdom and guidance. The company is famous for its history of steady, reliable returns and for its immense scale. The story of Berkshire Hathaway is one of remarkable transformation. It began as a struggling textile company in New England. When Warren Buffett took control in the 1960s, he began to change its path. Instead of trying to fix the failing textile business, he used its cash flow to buy other, better businesses. That strategy, acquiring strong companies and holding them for the long term, became the foundation of Berkshire's success. Over the years, this patient approach has built a corporate empire. It spans industries from insurance, railroads, and energy to candy. The company's fame comes not just from financial success, but from its philosophy. Buffett preaches value investing, wonderful companies at fair prices with simple models and durable moats. Berkshire Hathaway's historical performance is legendary, with long periods of outperformance versus the S&P 500. That outperformance created enormous wealth, but past performance does not guarantee future results. As Berkshire grew into a giant, growth naturally slowed. Doubling hundreds of billions is harder than doubling a small firm. Earnings come from two primary sources. First, the wholly owned operations, GECO, BNSF Railway, Berkshire Hathaway Energy, and more. Industry leaders generating steady cash. Second, a massive portfolio of publicly traded stocks. Large, lasting positions in high-quality companies like Apple, Coca-Cola, and American Express. These investments contribute via dividends and, over time, appreciation that lifts book value and net worth. Owned businesses act as a steady anchor funding operations, acquisitions, and strength, while the stock portfolio offers flexible exposure to global winners. Together, the two halves form a complementary system that has proven resilient and profitable over the long run, defining the company's unique character. A crucial part of Berkshire's success is its insurance business and the concept of float. Float is premiums collected today, invested for profit, with claims paid later, giving Berkshire a pool of usable capital in the meantime. With underwriting profits, float can act like capital at no cost, even negative cost, a Buffett cornerstone. This creates a massive, permanent, very low-cost source of capital. Berkshire marries float with patience, letting cash build until a high-quality business trades at a fair price. Patience enables decisive buying during downturns, when others are fearful. This is a structural financial innovation: low-cost funding, rational deployment, and long-term orientation. The machine finds existing value and acquires it efficiently. Insurance float plus patient discipline, Berkshire's secret sauce. Float fuels patient capital allocation, which fuels acquisitions, which fuels long-term compounding. Do nothing until it is right. Then act with size and conviction. Determining Berkshire's true value is complex. Simple metrics can mislead. The P/E ratio divides price by earnings per share. Lower can suggest a bargain. Higher can suggest expensive. For a complex holding company, reported earnings can swing due to accounting for unrealized portfolio gains and losses. Buffett urges looking past simple figures, assessing Berkshire's parts instead. Book value per share mattered for years, but now understates worth because many owned businesses sit below market value on the books. A better method: estimate insurance, the railroad, energy, other businesses. Add the equity portfolio at market, plus cash, then total. Intrinsic value equals the discounted value of cash a business can distribute over its life. Compare price to your intrinsic estimate. This requires study. Read reports, understand segments, judge long-term earning power. For Berkshire, Valuation is about comprehending a high-quality collection of assets, not a single ratio. Reasons to consider Berkshire: rational management, value investing culture, and long-term ownership embedded in the organization. Extreme diversification reduces risk. Weakness in one area can be offset by strength in another. Immense and steady cash flows, plus massive cash reserves and T-bills, enable disciplined deployment, especially in crises. But size imposes the law of large numbers. Future returns may trend closer to market averages. Leadership transition is a real uncertainty, and overpaying can still yield poor results. Even fortress-like firms face risk. Berkshire will likely remain a pillar. Insurance generates float. The railroad moves essentials. Utilities power millions. The plan aims for continuity. Greg Abel is expected to be CEO. Todd Combs and Ted Weschler help manage the investment portfolio. Key decisions: pursue large acquisitions, expand equity stakes, and consider returning more capital via buybacks or a dividend. Expect steadiness over sprints, diversified quality, financial strength, and rational allocation, a potential core holding for patient compounding.